My name is Peter Gunry. I'm the Chief Investment Strategist, head of the Saxo team of strategists. I'm joined today with my two great colleagues, Shara and Anna from the Singapore office, head of our FX strategy and macro. We have Ole here, which is the head of our commodities strategy, and Altea unfortunately couldn't join us today on bonds, but we'll definitely talk about bonds in the end and cover those viewpoints. But I think we should just go right into our core outlook. This is a sneak preview because it will not be out until tomorrow. So you are one of the fortunate ones that will see it first. And we are entering the third quarter of 2024, and we've called it the Sandcastle Economics. And there are already some questions. How do you define a sandcastle? And we'll we'll go through some slides and we'll talk about what it means and what is actually the essence of this. And very broad the very broad and very quick perspective is that Sandcastle, it looks good, it's fun to build, but intrinsically is very fragile to very small waves or wind conditions, etc. And we think it's a great picture on the current financial but also economic environment that we're in, and we'll show you why that is the case. This is the front page look of our core outlook. I find the illustration quite amusing, to say the least. There's a little bit of disclaimer. We always need to show that, so we'll just let that hang for 2 seconds, and then we can move on. So I'll start with the macro perspective, and then roll into our equity strategies around Sandcastle Economics, and then I'll hand it over to my colleagues after that. So if we start with a very, very high level picture on the global economy, as I always say, there are maybe 50 or 100 economic indicators you can choose and slice and dice in terms of providing you with your views on the market and the economy. And depending on your view, you can always find those that suit your view. But I think there are a couple of things that are, if you sort of tune out the noise, that are worth zooming in on. So the first one is the chart to the left. So this was an index that was created by the central bank in the US during the pandemic, when the central bank needed a very timely indicator on where the economy was. So it's called nowcasting. So you're not forecasting into the future, you're making a prediction of where the economy is right now. And as you can see here with the 12-week moving average, we have right now we have an economic growth rate in the US of around 2%. So the US economy is basically growing around trend growth. As you can also see, we have actually accelerated in the past couple of months. If you look at the chart to the right, that's the global composite PMI index. It's derived or calculated by JP Morgan Chase. And as you can see here, we have been steadily increasing the composite PMI index here, which covers both the services and the manufacturing index of the global economy. And the previous, or the most recent indicator we have had, looks pretty solid relative to the past. So I think we can say generally the economy is looking quite robust as we enter Q3. That's is part of the Sandcastle Economics. Things are looking quite rosy. There's a lot of support coming from the fiscal side, both in the Europe and the US, and the private sector is also holding up pretty well. If we take a bird's view of the different asset classes, this is a selection of different type of asset classes you can find out there. These are by no means, it should not be viewed as an investment recommendation. This is only for the overview of it. And I think it's pretty clear what type of condition or economy and financial market we've had this year. So very, very good year for private equity, developed equities. So developed equities is essentially the MSCI World. Emerging market equities have also done pretty well. China's efforts to try to rigorize their economy is part of that trade in the emerging markets, and then commodities have been doing pretty well as well. And then in the bottom, shouldn't be a big surprise, we have had probably bonds have not been doing quite well. Developed properties or real estate have not been doing quite well either. Actually negative returns, and the reason for that, of course, is when we came into the market was saying, we think that the Fed is going to cut interest rates 7 times this year, and as we progressed through the year, it became more and more clear that the economy was more resilient than expected. And at one point, we were all the way down to only one rate cut. And then some of the recent data points on the U.S. economy have increased the market's pricing of the Fed rate cuts. So now we are at roughly around two rate cuts by the end of the year. So this is the landscape. We've had a risk-on environment that has been good for equities. If we again take a bird's view from a different angle, you can calculate something that is called the financial turbulence index. So the concept is very simple. You don't need to understand the math of it, but it's simply that you look at a universe of asset classes and you look at how they behave relative to each other, and the more they sort of move again relative to each other in a way that they have done so in the past, the more orderly, the more calm the market is, and the more disorderly, so the asset classes bouncing around, like bonds would be up a lot and equities would be down a lot. That would typically be an environment where you have a lot of turmoil. Unfortunately, the labels I can see didn't really get on the chart that I showed. But basically, as you can see, we're in the lower end of this turbulence index, which means that we have a very calm financial environment. And I've tried to take historical data points since 2007 and said, okay, every time we have had this calm financial markets conditions and we have had inflation running above the 2% target, what has sort of been the composition of financial returns? And what the history shows, and not that that is a definitive indicator or guide for the future, that's not how it should be looked at, but then in those type of environments, what we have seen is we have seen a bias towards a positive return conditions for equities, but also commodities, as you can see here, and government bonds and cash equivalents has not really been where the party has been. So again, very high level perspective on the economy. And again, the turbulence index being as low as it is another evidence of this Sandcastle economics we're in. But as I said in the beginning, sandcastles, they do look pretty, and we have done a lot of things, and especially in the U.S. on the fiscal side, we are running historic fiscal deficits that we have not seen in recent time. The current fiscal deficit in the U.S. is roughly around 7% of GDP. The long-term average since the World War II is closer to 3%. So we're running a very, very aggressive stimulus from the fiscal side of the U.S. And this chart that we have shown here, what we're showing here on the left-hand side, for those that read our previous quarterly outlook will probably recognize this, and it's one of those themes we want to remind people about, is that the current trajectory in the U.S. economy is simply not sustainable. And I think the Sandcastle framework is all about thinking about the small changes that could happen to the system. So the winds changing, small waves destroying our pretty sandcastle, and there's clearly the debt situation. We have very bad demographics in increasing the amount of countries, in not only in the developed world but also in the developing world. South Korea could be mentioned as one case, China to mention another country, and we have inflation. This is a Fed survey that was done back in April. Inflation is a key risk. We have elections. We just had the French first round election coming out over the weekend. We have the UK election, but really the US election is really the big one that is a cause for concern. There could be that jolt to the market. We don't think, obviously, with the US election being in November, we don't think that will happen this quarter in Q3. So it is really calm before the storm, and the storm potentially is that Q4. But we'll get to that in 3 months from now when we write our next quarterly outlook. And then there is the whole geopolitics, and the geopolitics are intertwined, I think, with the US election, depending on who we get as the next US president, etc. And then potentially a final key source is the Bank of England. Just last week wrote a pretty big report flashing sort of the warning signals around the private equity industry. So they estimate that 10% of the private sector jobs in the UK is within companies that are owned by private equity companies, and they are seeing increasing financial stress in the private equity sector, which could jeopardize employment in the UK economy. So there are a lot of risks. We shouldn't be naive about it, but for now, it looks like a low volatility environment. I should probably also here on the fragility have put in what is called the dispersion trade, something we have mentioned in some of our recent podcasts and also commented on. It's The dispersion trade is basically a very specific options trade that is taking place in the US right now that is really suppressing volatility and accelerating the momentum that we're seeing in US equities. So that was sort of the macro picture. If we take the equity picture, then we can say this year has been all about Japanese stocks, to some extent also US stocks, but really the Japanese equity story has been quite aggressive. As you can see, the best performing region so far this year. Um, I know Shara will probably talk about the Japanese yen, because the Japanese yen has been part of what have been driving the Japanese equity market, because a weaker Japanese yen inflates the profits that Japanese companies are generating abroad when they are translated back into Japanese yen for their investors. It also increases our competitiveness in in international manufacturing markets. So this is really one of the key stories, and that could potentially be some more leg to this Japanese story. And then if we look across the sectors, it's really been very, very narrow in information technology. So that's where we find NVIDIA and Apple, just to mention a few, Microsoft. And then also communication services. Communication services is where we find Netflix, Meta, Google, etc., those type of companies. And real estate, not surprisingly, has been the worst performing sector, together with materials. And if you wonder what materials cover, it's mining companies and it's chemical companies. If we look at it from different angles through our theme baskets, you can see that the very hard themes have not surprisingly been mega caps, because that's where you have found a lot of these technology stocks. So there is a correlation there. It's semiconductors because of the AI theme. Nvidia, we all know that, has been really instrumental in that momentum, right? And then defense companies, specifically driven by European defense companies, and that's really also one of the big conviction we have around the U.S. election, that if Trump wins the U.S. election, then that will prolong the momentum that we're seeing in European defense companies for sure. And then, as you can see here in the bottom, some of the worst performing themes have been everything tied to the green transformation, energy storage, renewable energy. Very low energy prices, high commodity prices, and high interest rates are really, really creating as almost suffocating the green transformation, at least from a financial angle, because the market is still growing. It's just more difficult to make a profit. And talking about the equity market, again, coming back to the Sandcastle and what could go wrong, one of the clear fragilities that are building in our financial system, and in particular the US equity market, is the concentration risk. It's something we have talked about multiple times over the past couple of years. And I swore that in late 2021, when the technology bubble at the time popped and we got the high interest rates and we deflated, we had an ugly 2022. I was absolutely sure we would never ever see as a concentrated equity market as we had back then. And surely enough, I was wrong. It comes with the job of being an analyst, trying to predict the future. And here we are with an even more concentrated market than we have ever seen, based on some of the numbers I have got from other sources going back to 1969. We've never had as concentrated a market as we have, and that means that if and when, I think it's more than when, the AI tide turns, because our expectations gets too inflated and we extrapolate too much, then there is a severe risk for a pretty potentially steep losses in the equity market in a very compressed time frame, because of this narrowness that we are seeing in the market. So again, coming back to the Sandcastle Economics, is one of those risks to be aware of. And then finally, before I end my talk here, this is just some of our equity market views. We maintain the view we had from Q2. We still like Europe. We still think that the growth rebound in Europe is not really being appreciated enough in Europe, and we have had this disruption around the French equity market because of Macron's surprise election. That he put up after the EU parliamentary election, that was really a big defeat for his party. When we look across the sectors, the four most attractive sectors based on our data points, the energy sector, so oil and gas companies, healthcare, really a lot of momentum still due to the obesity and oncology, so cancer drug discoveries, and then financials because of high net interest margins still rolling. And finally, the information technology, we still see momentum and very high profitability, making that sector attractive, with the small caveat, of course, that you have the index concentration. So maybe if you want to have exposure to technology, maybe reduce it a little bit among the very large technology stocks, and maybe try to find a little bit of diversification across some of the medium and smaller technology companies could be actually quite a good idea to consider. So that was it. That was it. So I'll give the word to Sharo on currencies.
Right. Thank you, Peter. And yeah, I think we've set the stage for Sandcastle Economics and learned Peter's equity ideas as well, which certainly are very, very interesting going into this third quarter where things are likely to continue to look pretty, as he says. And that's what we think. But let's jump on to the FX side of things. And the title of our quarterly outlook FX chapter really is that risk currencies could outperform havens. I think that's a clear correlation to, again, the fact that, we will potentially in the third quarter remain in an environment where, of risk on really. And that's why we think the risk on currencies could continue to do some better than some of those safe haven currencies, whereas of course things might turn later on into the third quarter as we are getting closer to that US election in November. But more prominently, I think that will be a theme that we will cover in our Q4 outlook. So I think, of course, the first question when we talk about FX really is about the US dollar and whether it can continue to hold up. We've had two straight quarters of dollar strength now, despite the fact that when we started this year, it was expected to be a year of rate cuts. And, of course, the story has turned around quite a bit here. But overall, in the first half of the year, the rally that we've seen in the US dollar has come on the back of those gains in the US yields. So as you can see in this chart here, the black line really showing the US dollar index, which was so closely correlated to the blue line, which is the 10-year Treasury yield. That relationship seems to be breaking down more recently. But as far as H1 was concerned, it was really a story of higher US yields really pushing that US dollar higher, as well as we continued to push out those expectations around the Fed rate cuts for this year. Now, the big question is, will that story continue to hold up? I think there are reasons to believe that even though the US economic data is continuing to be, I think, like Peter said, there can be so many different indicators to look at. It has been a pretty mixed story. But what looks most certain at this point is that the exceptionalism of the US economy is fading. We are starting to see the output gap between US and some of the other major economies. For example, the Eurozone. Also, I mean, China is also stabilizing a little bit, if not, strengthening at this point. But so the gap between the US economy and these other major global economies, that has started to peak out. So that US exceptionalism story is something we wrote about in the second quarter outlook as well. That is starting to fade. Now, with that, we have seen lately that yields have started to go down in the US as well, but the dollar is not giving up its pole position yet. I think this just brings to mind a very classic reference that I often use when talking about the dollar. It seems like a scene from that old Wile E. Coyote and Roadrunner cartoons that we've all probably seen, where the coyote often finds himself hanging off a cliff or on a ledge, sometimes supported by a tiny branch or a pin. That's what US dollar really looks like right now. It's starting to bend. It's cracking a little bit. And of course, there is a deep canyon below, like in that cartoon as well, which is certainly the fiscal risks in the US economy. But that's another story. That's something we need to keep for another day. There are structural headwinds for the US dollar. But so far and into Q3, it seems it will continue to hang by that pin. And the reasons for that, despite this yield story turning, here I've listed three different reasons. So this slide seems a little bit crowded, but let's begin with what we see right on the top left side, where I'm again showing the US yield story here, but the story is a little bit different when again we compare it to the other major economies and their yields. And even though the US yield may be falling now, the 10-year yield has come down from 4.7% to about 4.3 or so now. But the US yields are still the highest of the bunch, and it seems like that is something that we can continue to talk about over the course of the third quarter as well, because the US is likely not going to be as aggressive in its rate cuts as some of the other central banks. We've already seen the European Central Bank, the Swiss National Bank, the Bank of Canada, the Riksbank, and the likes already starting to cut rates. The Bank of England may join soon. They have started to hint as well to a turn in their policy. But the Fed is still resisting that shift, and as what markets expect, it might be one rate cut or at most two rate cuts from the Fed in this year. So that yield story, I think, is obviously shifting, but the US yield is still the best in class, and that's what potentially keeps the US dollar supported for now. Then the second key factor on the chart on the right here is a positioning chart where we are showing really that the dollar positioning has also adjusted quite considerably. So back in April, the dollar positioning looked quite long, at least from a speculative lens, it was quite high. But now we've come down quite a bit from there. By no means this is a stretched long positioning at this point. We've seen long positionings being added in sterling, in antipodians like the Aussie dollar and the Kiwi dollar as well. So I think that has obviously meant that there is some scope for again the dollar to retain its strength. Certainly, positioning by no means is a clear indicator of what comes next, but it is still in some ways or the other it is a guide as to which direction we can go in, and I don't see any reasons why the dollar potentially also could not maybe even go a little bit higher from here. But what we have at the bottom of the slide, that certainly is the most interesting part, and certainly we'll be talking a lot more in the second half of the year, is obviously the risk of what happens with the US elections. We've had the first round of debate between the US presidential candidates last week. The outcome has obviously again been tilting a little bit more favor of a second Trump presidency as well, and that risk of a Trump presidency that brings obviously inflationary tides, as well as again tides that are at least cyclically positive for the dollar as well. Now, as we go into Q3, as over the weeks, we will be talking a lot more about how US elections and policies and campaigns are shaping out and what that means for the markets. And overall, from what I can see right now, it seems like the dollar will continue to enjoy some safe haven flows, some inflation risk flows on the back of those risks. So Q3 is all about heading towards those higher geopolitical risks. And in that scenario, I would think that the dollar is not ready to really give up its gains yet. So a little bit more of a sideways theory for the US dollar. And the focus still very much on central banks. And there could be some central banks which are obviously going to cut faster than the Fed. We're already seeing that. There are some, particularly I would want to mention the Reserve Bank of Australia or the Norges Bank, which are still maintaining their hawkish tones. I would say to a little bit of a degree even more than the Fed. And it's interesting to play FX on the crosses in this quarter with these currencies, such as the Aussie dollar or the Norwegian krona against some of the more dovish central bank currencies. And there I would highlight maybe, the Canadian dollar, where obviously the Bank of Canada is quite pressed to either continue to cut rates, and if at all they delay in a wait to follow the Fed, really, that would also create some hard landing risks for the Canadian economy. And that is a story very much present in the Eurozone as well, where if in case inflation doesn't shoot up again, they will continue to be pressed to move ahead with their rate cuts as well. Then moving along, yen is Japanese yen is certainly a big question. Again, Peter mentioned it briefly in his view on Japanese equities, and certainly we are back at levels in dollar yen where we are again debating whether we can see an intervention again or not. I've been saying that in my articles and the podcast as well, that the Japanese authorities have been very, very clear that they do not really care about a 160 or a 162 or a 165 kind of level. They worry more about the pace of decline in the Japanese yen. And a very a very approximate guide that we have from the Japanese FX authorities has been that they really worry about the yen depreciation when they see a 10 yen to a dollar kind of a move in a span of 1 month. And that is a criteria, if I just use that very, very broadly, that is a criteria that doesn't seem to have been met yet. I mean, of course, that does mean there's potentially more room on the downside for the Japanese yen, but that's a more immediate focus. Now, when we talk about the third quarter overall, where does the yen go really? Obviously, that's a big, big interest in the Japanese yen. And I would say there are two schools of thought here. One, something that have been discussing quite a bit again on the podcast has been the fact that we're entering this summer period for the Northern Hemisphere. Volatility tends to be usually low in these summer months, and the Sandcastle Economics, which makes everything appear good on the economic front, will also further add to the fact that volatility remains low. And when you have this kind of an environment, that is usually bearish for a currency like the Japanese yen, which is used for funding a lot of carry trades, which really become quite popular in low volatility environments. That's one school of thought. But then there's another school of thought where we can talk about the decline that we're seeing in the U.S. yields, and also the Bank of Japan being somewhat more serious, I would say, about policy normalization. When you talk about those two scenarios, those are really, looking, they kind of favor the yen. They're bullish on the yen. And given how undervalued the Japanese yen is, there is potentially, obviously, a lot of room there for recovery as well. So which way to go on the Japanese yen, right, into the third quarter? Personally, for me, I think I would take a more balanced view here. The carry is obviously very, very attractive, and any move from the Bank of Japan is unlikely to close the gap that the Japanese yields offer to some of those other high yielding currencies. So, of course, it's quite attractive to continue to get into those carry trades. But of course, I think there is this geopolitical risk that continues to hang above us, which means that probably tighter risk management practices would be warranted at this time. We've also seen carry coming back in some of the Latin American and other emerging market FX pairs, such as the Mexican peso or the South African rand, in the Indian rupee as well, where election risks are really out of the radar. So a lot of carry interest is coming back here as well. We've also seen a lot of interest shift to high quality carry, which is again being provided by the US dollar or the sterling. So these are currencies that continue to be supported because of high carry demand. But again, as we move in towards that US election later on this year, there is that risk regarding this reversal in carry trades, and that's why risk management is really, really important here. Remember the famous saying that we've had, that carry trades go up the escalator, but they go down the elevator. That's really important to keep in mind if you're trading Japanese yen, really. And I guess that's really it from me. That's the summary. We've been slightly, I would say, neutral to negative on the US dollar in Q3. I think we'll get a clearer direction into Q4 for the dollar. But again, like I said, it continues to hang by that ledge because of the geopolitical risks for now. And even if the Fed really adopts a more clear dovish tone, I think these geopolitical risks will continue to drive some safe haven flows into the dollar. The only real risks are seen in Canadian dollar or the euro, really, where the rate cut cycles are likely to be more aggressive. But Aussie and Kiwi and even sterling, despite the fact that the Bank of England may adopt a little bit of a more dovish stance, potentially the rate cuts from the Bank of England will not have to be as aggressive, and they would kind of be more in step with the Fed's rate cuts. So the sterling could potentially have again room to still maintain its gains. And that's all from me.
Thank you very much, Charo. We are continuing just with the commodity sector, and I've seen some have already posted questions. By all means, please do. So if you have a question, we're aiming at leaving something like 15 minutes towards the end just to answer some of the questions that's coming in. So thank you for posting, and please do let them keep coming. Commodity sector this first half has been a generally positive one. We maintain a positive outlook, I might as well say straight away, into the second half. We may see some of the sectors that have really been doing well potentially just pause a bit while they catch a breath, and we get some of the underlying fundamentals catching up with some of the moves. I'll just put in the total returns on some of the major commodities that we track, and as you can see, precious metals, not surprisingly, is right at the top, up 15%. Really quite impressive in a quarter, in a half year, where something like the dollar has moved up by around 5%. So generally that is a very strong performance. You can also see that the laggards has really been the grain sector. A large carryover from a good crop year last year has been weighing on prices, and following quite a volatile April and May, we are now settling a little bit in here. Weather-wise, we're seeing some decent outcomes across the world, and that's underpinning the outlook for supply, but obviously weighing on prices at the same time. Trying to put in some views here for the coming quarter. We are generally still positive on precious metals and industrial metals, but as I said, I think we may see that those sectors just pause a bit. Not to say we can't reach new highs, but not the kind of explosive runs that we've seen in the previous months. The grain sector, I'm positive simply because the risk reward right now is skewed, I would say, towards the upside, simply because there is a massive short in the market, but there's also the risk that the weather turns for the worse. So with that in mind, there's some concerns that could still surprise to the upside. Looking at the energy sector, we are really range bound, but generally the curve is still indicating some tightness in the coming months, and with that in mind, we maintain a constructive outlook for the energy. I highlighted as well on this first slide here some of the positioning from speculators. We know that they do carry quite a bit of weight in terms of setting direction for the markets, and and that's also a reason why some like the metals are a little bit we're neutral there in the short term, simply because positioning is already very much geared towards higher prices. So quite big long positions there right now that needs to be justified in order to avoid disappointments. But the commodity super cycle, as you can, this presentation is in the handout section, so you can dwell a little bit deeper into that. But we're still talking about the commodity bull cycle that we think we are still at the early stages of. We have been now consolidating for the best part of a year. We had a good run up this past quarter, but overall we believe there are still reasons to believe that the commodity prices can move higher in the coming months and quarters. Some of the reasons for that has been highlighted here. Some of them have a shorter, some of them have a longer term impact on the market, but generally we see these drivers as being important. And what you can see from the different areas is really that the commodities are not only dependent on demand. It is most certainly also the supply side that tends to have an impact, and outside factors like inflation, which we are somewhat concerned that we may see a structural higher inflation than what has been priced in. We all know about the climate change and the volatility it creates. Geopolitics, we have plenty of those about right now, and these will also play their part. But we have had three major cycles in the past 25 years, and as you can see, when they do move, they are quite aggressive, and we are just right now consolidating after that big COVID-19 stimulus-driven Ukraine war driven rally we had starting it from 2022 or 20 to 22. Dwelling into some of the major commodities that we track, I'm sure everyone would like to. Everyone's got an opinion about gold, and what is for sure is that we've had a very strong run up this year. We made consecutive record highs. The market is consolidating right now, and that makes perfect sense. The dollar, as I said, is up 5%. Bond yields are higher than where they were at the start of the year. Rate cut expectations has dropped from 7 to around 2, and gold nevertheless has been holding on to most of its gains. And we're well clear of, I would say right now, of risky territory, basically territory that could trigger long liquidation from funds that really got involved very early on in this rally. So a lot of these longs has been established below 2100, and that's why we're not seeing much volatility right now in gold price, simply because the corrections are not deep enough really to trigger any additional selling from forced long liquidation. The same thing cannot be said about silver and platinum, where quite a lot of the buying happened quite late in the rally, and that's been adding some downward pressure to prices recently. But most of it is not new selling; it's simply just longs being reduced. The another area that really caught the attention and the imagination during the previous quarter was the copper market. We all know the reason why. There is a long-term strong belief that copper prices will have to go higher in order to meet the green transformation demand that will continue to grow in the coming years. But we also learned the hard lesson that commodities are not like equities, where you can buy a stock in anticipation of strong earnings in the years to come, and therefore you want to get on the train as early as possible. Commodities are spot traded products. They have to balance on a daily basis, and if there is enough demand to meet supply, then prices tend to go nowhere. And what we did see, in fact, this past quarter was a massive run up in prices, driven not only by the longer term outlook, but also the AI theme catching people's imagination, that AI center build outs, data centers build out would require a lot of copper, and that just led a lot of new investors into the market. But we, as you can see on the right hand side here, inventory levels around the world at exchange monitored warehouses are at the highest level since pandemic in 2020, and that is not a scenario where prices can go higher. We need to see some of those stock levels being eaten into, being reduced before we can see the supply demand situation being in such that it can underpin a rally. So it's a wait and see. I think for copper that potentially could take quite a while. So that's why also we see a potential pause for copper here in the short term, while we wait for the underlying fundamentals to improve to the extent that current prices are being supported from the fundamental perspective. So generally wait and see on both, but overall still a fundamental bullish and positive view on both these key metals. Crude oil markets remains very range bound. I think we're seeing the most quiet price action since 2022. We have been settling into this steadily narrowing range, lower highs and higher lows, and basically for the past year and a half we've been hovering around 83.50 in Brent, and we are literally just a couple of bucks away from that as we speak. And that is there's not any major sign that will change in the short term, with the exception that there is some belief that, or looking at the structure of the market, as I said, that the market seems to be pointing a little bit towards the tightening side, and that potentially could spring a surprise to the upside. But the most of the volatility so far this year has been driven by geopolitical event risks, triggering speculative buying from hedge funds, who then ended up buying the highs and subsequently selling the lows as they got out of longs that didn't work. And that really has been the main peak and troughs that we've seen in the price action so far this year. So no kind of sustained move in the market. What will dictate the price as well into the second half is really who's going to be right, OPEC or IEA, or somewhere in the middle. You can see that the world demand outlook is just almost to getting to a ridiculous gap between these two major forecasters. More than a million, well, around 1.2 million barrel difference in the demand growth outlook for this year, considering that we already through half the year and we're now trading crude oil for August. So getting into the second half, we still have this massive gap. Some of that is potentially politically motivated, I would say, from both parties. But where we end the year is really going to determine where prices are gonna go. But also it will determine how much the OPEC will be able to increase production, as they announced a month ago from starting October. I think the reason why the market is taking it quite relaxed is simply that OPEC has said that they will only increase production if the demand warrants it. At the same time, there are producers who have been oversupplying. They need to bring their production down in line with their quotas, and that basically means that any increase may not be as strong or as big as feared. And overall, the reason why we're not at $90 or $100 when we see these big geopolitical flare-ups is simply the fact there's a massive amount of spare capacity held by some of the big producers in the Middle East, meaning that if prices really should take off, there will be a spare capacity available that could be put into the market to dampen the price increases. Finally, just as I mentioned on the grain markets, we got this ample supply situation, which has now been ongoing for the past year. Some great deal of volatility back in 2022 when Russia attacked Ukraine, temporarily causing raising concerns about supply of key crops and also some of the edible oils. But since then, the market has relaxed quite a bit. We had a bumper crop in 21. We had another big crop last year, and 22 and 23, and that basically means there's a big carryover into this current season. Basically meaning that the market is relatively resistant towards weather concerns. We did have a weather scare last month. We see that on the left-hand side there in wheat, which has now gone full circle. We saw a big jump based on Russian supply worries that has now stabilized somewhat. Wheat prices are back down. We just had a report on Friday from the USDA saying that the US corn acres will be higher than expected, and inventory levels will also be higher than what the market was anticipating. So we are at quite low prices here, and at the same time we are having a very elevated short position from hedge funds. As I said at the start, this is telling us a story that the market is ample supplied. There is a downside risk, but it's also telling us that there's a risk if we suddenly should see any change in the outlook in the weather outlook in the coming months as we're heading into the critical growing and harvest season. So do keep that in mind with these price levels, that that the positioning is already geared towards even lower prices, and that can obviously change if there is a sudden change in the outlook. So generally, a quarter where we're not going to where we don't expect a lot of fireworks. Generally focusing on the energy. We are focused on the grains from a risk perspective, and we're keeping our long-term positive outlook for metals. It's still there, but we may have to be a bit patient on that front regarding the next run-up, which we believe will happen sooner or later. And that basically kind of brings us to the end of our presentation. Maybe I should pass it back to you, Peter. You had time to see some of the questions coming in, and by all means, post whatever questions you may have, and we'll try to answer.
Yeah, so I think we have 16 minutes to go through some questions. If we can be very quick on some of the first ones. So the definition of a sandcastle, I think we provided that. It's something that looks good, like the economy right now, but there are fragilities, and I think both Sharo, Ole, and I have highlighted a lot of different risks that could make this right now in the short-term rosy outlook look quite different. Then there is the will the U.S. inflation rate and or interest rate drop in the second half of 2024? Well, we can say that the inflationary pressures are definitely less than they have been in the past. So, as you know, the market current pricing is that we will get lower policy rates in the U.S. and Europe by the end of the year. So, and over the next year. So, but you know, the market has been wrong many times before on both interest rates and inflation, but it does look like that, you know, it's leaning towards that we will get less pressure on inflation rates, inflation and interest rates. What do you think of the evaluations for the Max 7? Well, if you use the simplistic PE ratio framework again, then they look very, very expensive. If you look at it from a cash flow perspective, then it's less worrisome, but they are more highly valued than the general market, but they are also growing faster than the average market. Uh, I would say when we talk about valuations and you know, our U.S. equities on a bubble, I think it's very selective segments and parts of the equity market. And I think I'm not so sure you can say the Max 7 or not, but I will answer it from a different point of view. So there is another question from Tim on whether it's a better idea to buy an equal weight. Or that's at least how I read the question. So should I buy an equal weight over a market weight based if I wanted to have exposure to the S&P 500? As I think it goes back to the Max 7, it goes back to the index concentration. So just simply from the math of it, unless we believe that, you know, the Max 7 or, you know, the ecosystem in the mega caps part of the market, unless we think that they gobble up the entire world, which I think is pretty unrealistic because we always are wrong in our assumption about that, there will be a turning point where the market will not continue with an ever increasing market concentration. So I would definitely lean more towards an equal weight perspective, and that's the same as saying that it's probably a good idea to be underweight the Max 7 relative to the rest of the market, and that's a way of expressing that. What is our view on the defense shares? Well, I think I said it, but when we maintain a positive view on European defense stocks. Some of them are getting a little bit potentially outrageous on the valuation side of things, but I will say as a counter argument that. The ball here is moving very fast, and I'm not sure actually the analysts are updating their forward-looking estimates fast enough to the underlying demand that is coming, because the EU is constantly moving the goalpost here in terms of how much stimulus they pushing into the European defense sector, and it also has a positive sensitivity to a Trump victory. Okay, I answered a lot of questions there quickly. Maybe Shara, I don't know. What do you fancy? Do you want to take a question on the French election? There's a question here. What is the impact on the French election on the economy and the markets if the National Rally wins the majority? What can we expect? Question mark.
Yeah, I mean, of course, the results out today have resulted in somewhat of a relief rally. But I mean, I've been on TV today and in the podcast as well. I've been raising concern about how long lasting this relief rally will be if you're looking at it from a very, very short term lens. Because, of course, there's going to be next few days is going to be all about the horse trading, right? And really, there are going to be three options from here. One, after that second round on the 7th of July, do we get a hung parliament? Which does mean policy paralysis, but does it really, is that really the worst case outcome? Potentially not. I think it's something that the markets can still digest. The second possibility is really that we could potentially see an alliance of parties that are big enough to really block the far right from reaching, a place where they can form the government. That is obviously the best case scenario, and that is where the market is skewing towards now in that relief rally that is ongoing today. And of course, the worst case scenario for the markets being a win for Le Pen's rightist party, where there will be risks of radical spending plans or more adverse relationship with the EU as well. So potentially from where it looks right now, and I can only speak for FX, where for the euro dollar, I do think that any rallies beyond 108 or something in euro dollar could remain a stretch, given all this political risk is still very much on the radar. There is still quite a risk of a hung parliament, which, like I said, could be still the best case outcome, but it's not like we cannot see a full move towards the right. Now, the big question will also be, after we get those final results, as to how aggressive the fiscal policies can really be in any given scenario. Because, of course, even with Macron, he's been struggling to bring down the deficit as well. So, and Peter has very nicely written an article comparing France's situation to Italy, where Meloni herself has also stuck to very orthodox economic policies. So is the situation all that bad? Of course, I think. And one of the articles that I wrote earlier on France elections, what I've been highlighting for long-term investors, particularly, that all this geopolitical uncertainty, it obviously creates a lot of volatility in the near term, but it can also offer some very strategic entry points for long-term investors. And if I think any potential outcome at this point does not seem to change the outlook for France's fiscal dynamics in a very big way. So I guess, yeah, that's all I can say.
I want to give the next question to Ole. Before I do that, Ole, so that's the outlook on cocoa. I just want to quickly answer. There was a not a question, but more like a request. Well, we could mention Eastern Europe a little bit more next time. It's an interesting area in the Eurozone due to growth rates, etc., geopolitics, and that's absolutely absolutely noted. Sometimes the problem with Eastern Europe is that the capital markets, financial markets, are not that deep in that region. So, but maybe except for Poland. But so that's definitely noted. And then, and Ole, before I give you the word on cocoa, I also want to mention that Shara mentioned a couple of times, and I did it myself. We just blurted out podcast. So I just want to just tell you that our team we do a podcast, two podcasts actually every week, one on macro, one on equities, and sometimes it's also thematic. So you're also on the podcast, Ole, but Sharo, generally you do the macro input on the Mondays, and I do later in the week the equity input. So Saxo Market Call podcast, you can just find it on your podcast app, and definitely we would love to have you as a new listener. And then also in terms of all the things that we write in terms of research, a lot of what we write obviously is in English. Some of it is also translated into local markets. You can find it in the platform under research, and then inspiration. You will find everything that we write. If you are in a local jurisdiction and you have it, and even if you have set your language sessions to English, it might be so that you can't find our research, but it's always available on website home.saxo. You can always find it there under inspiration. You can find all our things that they are widely available. So I really encourage you to stay up to date with all our viewpoints on the market. And now, Ole, that was a long intro. Sorry for that. What is the outlook for cocoa this quarter?
Well, obviously, it would be easy to say I don't know, but what I do note is that the cocoa market has gone through a terrible 6 months, and to the point that basically the market, I would say, broke down. We've seen the kind of extreme volatility triggered by production being centered, coming from a relatively small area, which then made it very exposed to weather developments, and that's the West Africa countries of Ghana and West and Ivory Coast. Prices have started to stabilize, coming down a bit. There is some we through, I would say, probably through the worst, but again, we need a proper bumper rally, bumper crop this coming for large crop season, which starts from October this year, run to March next year, and that's really what the future will hinge on. But it's difficult to get any signal value out of the cocoa futures market, simply because open interest has collapsed. Hedge funds has left the market. It's been a market where where liquidity has become a bit of a premium. But I think the main thing is to note that the spread between cocoa for immediate delivery and March next year, which basically includes the next season, is trading roughly $1,800 below the current. So there is some expectation that prices will ease, soften further in the months ahead. But weather will clearly be a major determinant for that. And then we simply need a prolonged period of stability for the market really to I would say to start functioning properly again, because 5 to 10% daily moves is clearly not something that entice that makes it easy for producers and the consumers of chocolate to hedge themselves, and that just creates a very disjointed market. Let me just take a couple of the others. We still got some time left. There's a question about uranium. Uranium, again, also was a very hot topic at the start of the year. It triggered a rally that was unsustainable. A lot of speculative money flowed into uranium. And again, uranium is a bit like some of the others. It's relatively easy to predict, calculate what kind of demand is going to be needed in the years to come. And I think the main takeaway is simply that uranium is a long-term bullish story. The supply is likely going to become tighter as we see production or demand increase in the coming years. There is rollouts, especially in Asia, of new nuclear reactors. I think Europe is warming to the technology once again, and that will also increase the demand in the coming years. But it is a long-term outlook, and I just have to warn against the speculative ETFs that basically gulp up physical uranium. That's an ETF holding physical commodities is okay as long as it's not of a fundamental national interest or need. Something like gold, which gold ETFs can be ETFs can take a lot of gold out of the market, and the market doesn't really care, or the politicians doesn't really care. But if we run into a situation where the market becomes tight because speculators are sitting on mountains of spot uranium, then obviously there is a risk of political intervention, which could render these force these ETFs to shut down. And that's why the whole idea that uranium should be squeezed higher from speculative interest, taking uranium out of the market, is simply a false assumption in my opinion. It will not be allowed by governments to hold if we really should see reactor or nuclear companies start to run out of uranium because they can't get hold of it, because it's squeezed out of the market. So just a point on that. Lithium is still struggling from the overhang of supply. Battery demand has softened a little bit. EV sales is also just seems like we're plateauing a little bit, and that basically means there is still an overhang of lithium, which needs to be worked through, and we probably ultimately, just like natural gas, need to see some of the producers cut back production in order to stabilize prices. But we're still hovering near the lows that we now seen for a couple of years. Finally, should I just take coffee as well? Someone asked about coffee. Coffee is just like cocoa, one of the and to a certain extent sugar as well. One of the soft commodities where demand is or supply is really dependent on key areas, Robusta for Vietnam and Brazil on Arabica. And we are getting reports that the outlook for production is being challenged, not only in Vietnam, which was already realized, but especially also in Brazil. So I think the underlying trend for coffee potentially points to higher prices from here. Whether it's going to end up in a squeeze, I very much doubt that. But underlying, it looks like we are heading towards a more tight outlook for coffee, and that will continue to keep prices supported. Peter?
Yeah, we're running out of time, but maybe Sharo, if you can be rapid. I think there are an interesting question on why the Swiss franc is still going up against the Japanese yen, and then maybe very quick comment on your views on Scandinavian currencies, and then I think it's a wrap.
Right, and I saw there's one on Japanese yen also, so there's quite a lot of ground to cover in 2 minutes rather. Anyhow, yeah, the Swiss franc, that's an interesting one. Of course, there was a little bit of a shift in tone from the Swiss National Bank after their first rate cut in March, and they started to be concerned about this franc weakness and how that could fuel inflation. I think that was one factor, but more importantly, it's really been the safe haven flows into the Swiss franc on account of that European election uncertainty, France election uncertainty. Japanese yen has not been able to act so much of a safe haven given the US fiscal risks, but also, because the risks, election risks for now have been more concentrated in Europe. And there, of course, the Swiss franc serves more of a safe haven. So I do think that the Swiss National Bank is, of course, very, very focused on the currency. We're getting a new governor there for the Swiss National Bank as well. And I think currency intervention will remain a key focus for them. But I would say that from here on, there is going to be limited room for the Swiss National Bank to cut rates. They've already cut rates twice, and I think it's going to get more and more difficult. So potentially some strength, but of course, undue strength in the franc will also tend to slow down the US or the Swiss economy, I should say. So I guess it will be pretty much of a sideways, potentially trend for the Swiss franc. For the Scandinavian currencies, it certainly looks like there's a divergence happening between the NOK and the Swedish currencies, where, of course, again, that's on the back of the divergent stances of the central banks, where we have had the Norges Bank going in for a hawkish hold recently and kind of saying that the rate cuts are unlikely this year, only potentially will start in 2025, whereas the Riksbank has been somewhat more dovish. So I would say that there's quite a bit of clear divergence there. And the one on Japanese yen, that's very interesting. Does intervention make could have any impact? I mean, we've seen that in April, billions of yen spent, but we're back above, those levels. We're at closer to 161, record lows again for the Japanese yen. So potentially, I'm not saying this, history says this, intervention, as long as it is one-sided, it has no impact at all. Fundamentals remain the same. So yeah, back to you, Peter.
That was fast. Thank you very much, Sharo, and thank you, Ole, as well. It's always a great pleasure to do presentations with you two, and I really hope you enjoyed our. It was 1 hour. It was long, but a lot of information, a lot of things going on in the world. It's certainly not going to be that quiet of markets. I know it is Sandcaste Economics, so the environment is benign right now in the short term, but we flagged a lot of things to consider as we get closer to the Q4, because that's where really the action will kick in, with especially the U.S. election taking center stage and an attraction in the market. So, but so stay tuned. The outlook will be out tomorrow, and we just wish you safe trading out there, and good luck, and thank you for listening in. Thank you.